Hey everyone, welcome back to the Success Blueprint, where we break down big concepts into simple frameworks you can use in your life and career. This is your host, Sunny. Today we're diving into some must-know financial terms, including asset classes, financial statements, and the key ratios investors rely on. These terms and valuation metrics we will use in subsequent videos for stock selections. Whether you're starting your investing journey or just want a refresher, you're in the right place. Let's jump right in. First up, asset classes. An asset class is simply a group of investments that behave similarly in the market. Here are some of the major ones you should know. Stocks represent ownership in a company. When you buy a stock, you're buying a piece of that company, and you benefit when the company grows and earns profits. Example: buying shares of Apple means you own part of Apple. Bonds are loans you give to companies or governments. In exchange, they pay you regular interest and return your principal at maturity. Example: a US Treasury bond is a loan you make to the government. ETFs are baskets of investments, like stocks or bonds, that you can buy and sell on stock exchanges. For example, an S&P 500 ETF holds shares in the 500 largest companies in the United States. Gold is a traditional store of value, often used as a hedge against inflation or economic uncertainty. You can invest by buying physical gold, gold ETFs, or shares of gold mining companies. Real estate investing means buying property to earn rental income or to benefit from the property's value increasing over time. Bitcoin is a decentralized digital currency and is sometimes called digital gold. Cryptocurrencies are highly volatile, but they have gained attention as alternative investments. Dividends are cash payments that some companies make to their shareholders, usually out of their profits. It's a way for companies to reward investors. For example, if you own shares of Coca-Cola, you might receive quarterly dividend payments just for holding the stock. All right, now that you know what you can invest in, let's look at how to understand a company's financial health. So, financial statements are basically reports that show how a company is performing financially. There are three main types. The income statement shows a company's revenues, expenses, and profits over a period. It answers the question, did the company make money? The balance sheet shows what a company owns, which are called assets, what it owes, known as liabilities, and the owner's share, or equity, at a specific point in time. So, the cash flow statement basically tracks how cash enters and exits the business, all from operations, investments, and financing. This statement, shows a company's real liquidity, not just its profits on paper. Knowing what's inside the financial statements is important, but interpreting them is even better. That's where financial ratios come in. Financial ratios give you quick insights into a company's performance and valuation. Let's break down the key ones. PE ratio, stock price divided by earnings per share. It shows how much investors are willing to pay for $1 of earnings. PEG ratio, PE ratio divided by earnings growth rate, helps compare companies with different growth rates. ROAS, profit made on an investment divided by the investment's cost. It measures how effective an investment is, shows how efficiently a company generates profits from all capital it uses, both debt and equity. RO, return on equity, net income divided by shareholder equity. It shows how much profit a company generates with the money shareholders invested. ROA, return on assets, net income divided by total assets. It measures how well a company uses its assets to generate profit. EPS, earnings per share, net income divided by the number of outstanding shares. A higher EPS usually means higher profitability. EBITDA, earnings before tax and depreciation, a measure of a company's overall profitability, removing the effects of financing and accounting decisions. The bottom line profit after all expenses, taxes, and costs. Cash flow metrics. It is actual cash moving in and out of the business is what we're talking about here. Cash flow yield. Operating cash flow divided by the company's market value. That's the key metric. It basically shows how much cash an investor is getting for every dollar invested. Now, let's talk about debt. This is the money a company borrows and, of course, must repay over time. If you take total debt and divide it by total shareholder equity, you get a ratio called debt to equity. A higher ratio means the company relies more on borrowed money, which is definitely something to keep an eye on. Depreciation. Here's another important idea, that the gradual reduction in the value of an asset over its useful life. For example, a $10,000 machine might depreciate by $2,000 per year over 5 years. Simple as that. And there you have it. A crash course on key financial terms, from asset classes to financial statements to vital ratios. Understanding these basics can help you make smarter investment decisions and better manage your money. If you found this helpful, make sure to like, subscribe, and share this video with someone who's ready to level up their financial game. And let me know in the comments which topic you'd like a deep dive on next. Maybe valuation metrics, dividend investing, or cash flow analysis. Thanks for watching, and I'll see you in the next one.